Hi, I'm Joseph Williams, veteran TMT reporter at S&P Global Market Intelligence, focusing on capital markets, M&A, private equity, and other cross-sector financial news. Welcome to MediaTalk, our monthly podcast. The tech M&A market has undergone a major overhaul in the past 9 months, coming off brazen historic highs to very cautious and increasingly conservative lows. With me here is 451 M&A analyst Melissa Incera. Melissa has been following the same M&A trends very closely with a particular focus on that software application sector. Hi, Melissa. Thank you for joining me today.
Thanks so much for having me.
Absolutely, Melissa. We have a lot to discuss about this rapidly changing environment. Before we get into specifics, I'd love to get your high-level general thoughts about what's driving these rapid and massive changes in the market.
Sure. Yeah. I think if we're going to talk about the transition we've been through this year, it makes sense to kind of just highlight what happened last year, right? Which is we saw around tech M&A at record valuations. And what was driving that was there was a ton of cash floating around in the environment. It was cheap. It was very abundant. And at the same time, tech was also experiencing this kind of surge of necessity, right? As the pandemic brought about a lot of changes in people's lives, where they worked from, how they spent their money, et cetera, et cetera. And because of that, now we're undergoing a massive transition where we're moving from one of the most prolific and lavish capital environments that we've ever seen into one that's quite the opposite, where there's a lot of uncertainty, a lot of risk adversity. And to your question, right now, capital is getting a lot more expensive as interest rates go up. Growth stock valuations in the public market, which is what tech valuations are, have dropped dramatically. And we also have a slowing economy, which is impacting companies everywhere, their ability to post revenues and show strong growth rates.
Absolutely. Certainly. And at the beginning of this year, coming off 2021, I think some of us that watched this sector were wondering how long tech M&A could continue to post the size and pace of metrics that it was doing. It started its sort of record run at the end of 2020. It was well over a year before things started cooling off. And even after January, which really continued the trend, surprisingly enough, and into February, it was still running at 2021 levels. And even after that, you started to see very clear signs that it was retreating a bit. Like, there were still major deals being done, but like each month's activity on values and volumes hinged on these big deals. But now, more and more as the years worn on, we've seen increasing concern, risk aversion, a chatter about the market being hollowed out against this backdrop of, if you look at the whole year's metrics, it's actually pretty impressive historically. Maybe you can tell me where we're at now and what's contributed to that building concern over this period when, on paper, the M&A market has looked in the recent history pretty robust.
Yeah, and I think you hit the nail on the head, right? When you talk about how Q1, the beginning of 2022, it was high flying. As you said, it looked like a continuation of 2021. And then it's been a gradual kind of slide down to where we are in Q3. So Q2 looked a little bit more transitional. There were still some big deals, but a lot more turbulence. That's where we saw the markets really bottom out. And we saw the nature of deals start to change too. Q2, we saw a lot of mega takeover deals as a result of public valuations being down, some very opportunistic buyers taking advantage of maybe some sitting ducks or some companies that are coming from a position of weakness in the market. And now, as we close out Q3, we're really starting to feel the market slow. And so not just to the point where we're reverting back to where we were pre-pandemic before the mania of last year, but it's looking and feeling like a brand new environment. Not a ton of big deals. Usually we track, our team will look at billion-dollar deals to get a sense of kind of the robustness of the market. Last year, we were averaging about $40 billion deals per quarter. And that's been on the downward slide since then. In Q3, we saw only $14 billion deals. So we're losing the high end of the market. A lot of the deals that we're seeing are much smaller fish at lower valuations. And that's the projection for the way it's going to continue through the end of the year.
Gotcha. Yeah, no, totally. So if you look at the year overall, you might still see some historically impressive numbers. But the fact of the matter is each quarter, each month, each week wears on, it's just eroding and eroding. Let's talk about some of the more specific forces contributing to that trend, that erosion. And like you touched briefly on valuations dropping, on this caution that's entering the market. We also have a changing regulatory backdrop, it seems. What's driving this valuation concern at a time that tech was growing not only in equity market interest, but with their revenue, with their sales and stuff like that? And then on the financial buyer side, you had private equity just flush with cash, being highly competitive for these assets, paying huge valuations to add to their technology portfolios. So with all that back, what's creating this immediate shift in risk aversion? What's like really threatening deal making right now that's causing this pullback?
So as always, there are a confluence of factors that are playing into this added degree of caution and risk aversion in the market. So one of the biggest ones is that there have been exit opportunities for companies, particularly late stage companies, are starting to close. So with the fact that the public market is decidedly in bear territory and has been all year, we're not seeing any IPOs. We're also seeing public tech buyers who are historically the most prolific and tend to spend the most, right? Pay the richest multiples for their targets, are retracting from the market. At the same time, other buyers are finding capital a lot more expensive to come by, right? So private equity, for instance, there's a record amount of dry powder in the market, particularly because last year there was so much cash available. A lot of it still is, but this year, private equity firms are having a much harder time achieving their fundraising goals. So they're being a lot more cautious, a lot more diligent as it comes to deploying available capital.
Gotcha.
And above all, the valuations are coming down significantly.
So yeah, all like the dynamics you just mentioned are all like pressuring valuations. As like you said, these potential sellers, these targets are seeing fewer exit opportunities. So they're like pressed if they do want to create some kind of liquidity event. They're pressed to be more like seek out buyers and offer good terms, as opposed to last year where like big private equity firms were acting as tech consolidators and the strategic buyers were doing great post pandemic. So there was just so much upward pressure on valuations.
Yeah, absolutely. Absolutely.
So this private equity dynamic's interesting. It's been cool to watch over the past 2-3 years, and longer than that, honestly, but really got to a frenzy during the past 2 or 3 years. Thoma Bravo, some of the other large financial buyers in the market were scooping up as many tech targets as they could, and they were like consolidating these portfolios and combining assets in a way strategic companies that looked similar to strategic buyers, and they were also paying these rich multiples. Fundraising was high. Investors just were putting a lot of money to work there. And then it's like private equity has been part of what's been propping up a lot of these metrics, probably to put a lot of that dry powder to work. You mentioned they're just having a harder time with fundraising. So is this sort of just a forward-looking caution on the part of private equity? They do still have the dry powder, but they're just forecasting the growth in their capital start to dwindle. So they're trying to like circle their wagons in a different way than the strategic guys.
Private equity has been really interesting to track because their buying patterns aren't changing as dramatically as we're seeing from strategic buyers, right? Strategic buyers, particularly public strategic buyers, are passing along the valuation discounts to their targets in many ways. So the general consensus now is private market valuations are a lot more favorable than public, which has not typically been the case. And a lot of that is due, as you're saying, to private equity buyers who are reaching deep into their pockets to shell out for targets. But again, consistent with what we're seeing across the rest of the market, deal count has slowed dramatically, and deal size has also shrunk. The general trend we're seeing is that more and more private equity buys are looking like platform add-ons as opposed to more strategic and a little bit riskier core platform buys now, just because there is that added degree of caution.
Yeah, no, that's interesting. And then how are we seeing that very recent third quarter, let's say, private equity numbers? How are those looking? Because I know if you separated in some sectors private equity from strategic buyers, the valuations private equity was paying across an entire sector were averaging in the double digits sometimes. Now, like, how is this new sort of forward-looking caution affecting the numbers for private equity acquisitions?
Yeah, as we were saying, I think it's reflected more in the deal count, right? And the total deal value that PE is posting for like tech targets in aggregate. The valuation multiples have come down, but really not as dramatically as we've seen from other buyer classes. Definitely not as rapidly.
How's this increased caution playing out? Are we seeing the deals that are falling through because of these financial market dynamics? If you get any examples there and like how that worked out. Again, Tom and Bravo were throwing money around a lot through the past few years, and we're seeing them renegotiate deals and stuff like that. Any color on down to the specific deal level there?
Yeah, absolutely. I will say deal terminations have been really interesting to track this year because the market's been so volatile, right? There's been a lot of fallout for different reasons, particularly because valuations have come down so dramatically, right? There's often, or we're seeing many deals where there's a huge discrepancy between what was on offer initially and what the market rate is now around the date of completion. So Thoma Bravo's acquisition of Anaplan is a great example. They didn't back out of the deal, but they did renegotiate slightly, and it ended up with about a 3% haircut to the original price, which they articulated had to do with some kind of actions that happened on the part of Anaplan after the agreement was signed. But I guess the takeaway there is buyers are getting a little bit more diligent. They're getting more cautious. Another thing, as we're talking about forces working against tech and M&A right now, I think we have to talk about regulatory forces that have really come right into the mainstream media this year. We're seeing some headwinds for some big deals that came through earlier this year. So great example would be Broadcom, VMware. Even it could be argued that there are a lot of buyers that are staying on the sidelines. For example, Facebook. We've done a lot of coverage of Facebook's M&A strategy or lack thereof recently because these regulatory forces are a big question mark, right? And they're making buyers apprehensive.
Yeah, that's interesting. So it's not just necessarily assumed the regulatory scrutiny and risk is not necessarily something that they just accept as they try to move forward in this environment. It's actually adding to a forward-looking wait and see caution. Yeah, no, that is interesting. What you mentioned Broadcom, VMware, the semiconductor sector has come under a lot of sector unique international scrutiny on the part of regulators. The current FTC is almost blatantly signaling that they're going to be judging deals by new criteria, and they've actually blocked some deals that in a 2020 paradigm would have sailed through. Any specific examples there or any like dynamics that illustrate that?
Yeah, absolutely. So there have been a few examples. The one that comes quickest to mind, specifically since I just mentioned Facebook or Meta, they made a really interesting move last year where they attempted to acquire a company called Within, which is a virtual reality fitness app, and keeping with their transition into kind of a metaverse company. And the FTC, very interestingly, blocked the move in July, which at first glance is pretty odd, right? Because Meta doesn't have a foothold here. It is not seemingly that anti-competitive. But the message there was, hey, you can't just buy your way to the top anymore, which has been Meta's model, if you can conceivably develop this in-house. So from my limited knowledge of what the FTC's approach, this is not a type of ruling that we've seen before and could be indicative of a very different type of attitude as it relates to regulating big tech, which has been pretty vocal about clamping down on, but it's an interesting kind of unexpected example.
Absolutely. Yeah, no, this idea that there's going to be more pressure against deals that can be developed in-house could potentially, if it actually like plays out rigorously and broadly, work against the primary growth strategy on part of tech companies, right? That they expand and grow by acquisition because they deem that's more efficient in many instances than building a team to do a specific thing. That I could certainly see how that clip the wings of a big strategic motivation to get deals done. That is interesting. Yeah, so we've talked about this regulatory pressure, which is unique and uniquely impacting potentially a significant strategic motivation for tech M&A as competition is declining, as strategic buyers are circling the wagons. Some have retreated a lot just in their sales from the pandemic period. And then in general, there's just more caution. There's just more like forward-looking risk aversion. And then on the private equity side, you might still read headlines about how much dry powder there is out there. As fundraising gets more difficult, they have more incentive to hold on to that dry powder. So among all these dynamics and among the current quarter where this retreat in M&A is really has continued to decelerate to where we're, like you mentioned before, below pre-pandemic levels even. How do you see this playing out? If private equity and strategic buyers and a lot of the motivation to retreat from the M&A market, not all, but significant amount, is to just kind of hold on and see what happens. What's going to happen? Like, when do you see a scenario in which things loosen up again and all this dry powder goes back in there? Or do you think we're going to be in this sort of like valley retreat period for a long time based on the longevity of these trends?
Yeah, I think for at least a little while longer, we'll see the trend that has emerged through Q3, which is a lot of really small deals, a hollow middle market, maybe an occasional big mega deal because valuations are low. I think we'll see that continue within the near future, at least through year end. I think we're coming to a point where a lot of companies are going to be hitting a really important crossroads, right? So a lot of young, smaller startups raised capital at the height of last year's kind of boon year. And they're going to start, usually those funding rounds are designed to last about 18 months. So we're going to start seeing a lot of these companies run out of funding and then have to make a decision. Hey, do we try and raise another round where there's really not a lot of capital on the table anymore? Or do we sell? Do we try our luck hitching our wagon onto someone else? So I believe that's a lot of what we'll see moving end of this year, early next year as a primary driver of deals. And then bigger picture, cash is expensive and the people aren't parting with it very willingly right now. So the market is really looking to the Fed, looking to see how monetary policy will shake out. How high do they have to go to get us out of the inflationary mess we're in? And will that tip us into a recession? So for me to see that things really change, for me to anticipate that things will really change, I think we'll probably have to see a pivot in terms of monetary policy to see investor sentiment really pivot as well. But gotcha. I guess I'll caveat that with a lot of investors, growth stage and early stage, see an amazing market opportunity right now. And we talked about Thoma Bravo earlier, right? That's an amazing example of a private equity company. They were founded in 2008, right? They grew to their prominence they have today out of a period like we're experiencing right now. A lot of people will take advantage of this really unique investment opportunity, right?
Absolutely. Yeah, no, that's a really good point. Obviously, there's a lot of uncertainty and a lot of people talking and writing about that, but you also see interest in investors and taking advantage of this low valuation period if you can make it make sense with interest rates and everything. But yeah, that is a really good point because the 2008 recession did create a new kind of investment firm almost just to take advantage of those market lows. Yeah. And then talking about the run up in valuations in fundraising for private company, small company valuations and the VC market and stuff like that. As an example of an outlier, we did see Adobe pay a pretty startling price for Figma. And to be fair, Figma's got a really interesting growth story. And then Adobe is seeing the market to some degree shift away from its distribution style. So there's a lot of strategic specifics in there, but at the end of the day, at a time when it's increasingly becoming a buyer's market and everyone's more cautious, and you have Adobe out there doing a deal at like 2021 levels and late 2022. So do you think that's just going to be an outlier, or do you think there might be still some compulsion for companies to pay high multiples outside of just the individual strategic motivation going forward? Do you expect to see any more of these kind of like big prices paid to create growth stability in a slower growth company? Or do you expect the Figma Adobe deal to be one of the last fireworks of the big historic high period?
I would say that I expect it to be an outlier and one of the last fireworks, but I would have said that back in June about a number of deals, and then Adobe Figma happened. So I guess this year, more than anything, has been characterized by the extreme duality of the market, right? The really high-end record, most expensive deals on record, and then the fact that there's not a lot in the middle. But I guess, I think you only really have to look at the market's reaction to the Adobe Figma deal, which is that Adobe was severely penalized for it because it was not in keeping with the current market dynamics.
Absolutely,
So I guess I'll also throw out there, in contrast, another big deal that happened Q3 was OpenText's acquisition of Micro Focus. Yeah, it's a really interesting example that really shows how much the market has declined, and that OpenText is buying the way it always has, right? It buys legacy vendors past their heyday, but that have cash generative power, and it doesn't pay much of a premium for them. And that's what's available right now, right? There's a lot of discount deals, a lot of opportunity for maybe not hostile takeovers, but unsolicited takeovers. And that's more in keeping with what we're seeing as opposed to Adobe Figma, which was very unexpected.
Yeah. It was a deal that would have happened in more of a seller's market there. Yeah. And even in the case of, you have their public market, they still paid twice the public market valuation, but that only got them like 2x, like double public market valuations. Typically a pretty big swing upward, but at the same time, if it only gets you a 2x, that's still a deeply discounted buy.
Yeah.
No, interesting. Yeah, it'll be cool to see how it could be painful, et cetera, et cetera. For those of us that follow it and nerdy curiosity, it'll be really interesting to see how these dynamics play out, because it sounds like there's a lot of forces pushing and pulling, and thanks for going through this with us. It's an interesting time to unpack all those forces and motivations.
It's a super interesting time. A lot is happening, a lot to unpack, and I'm sure we're going to see a lot more surprises before year end, if recent history has anything to show us.
Absolutely. Like you said with the Adobe deal, it's like you thought the last one of those would have been coming in. The Adobe thing happened. I'm like, here we go again. But it seems like this turbulent backdrop is creating a lot of ambivalence. And I definitely wouldn't be surprised if I was very surprised next month. Thanks so much for joining me, Melissa, and going through this. Really appreciate the detail and color here. Yeah, and you can see Melissa's work on our platform. It's really great research.
Thanks so much, Joseph. It was great talking to you.
And thank you for joining us for our regular MediaTalk podcast. Again, I'm Joseph Williams, and shortly we'll have another installment covering another interesting topic in the sectors and trends of the broad TMT industry.